Hello everyone, Luke McElfresh here again. In today's video, I'll be working through some practice problems from Chapter 9, which is titled Net Present Value and Other Investment Criteria. So in this chapter, we look at different methods that companies will use when they are evaluating capital budgeting projects. You will see that each of these different methods has its different strengths. It's important to understand that when utilizing these methods within the corporate environment, that you would most likely be utilizing more than one method when you are evaluating these different projects. For our purposes during today's video, most of my evaluations or most of my calculations will be done using the TI-BA2 Plus financial calculator. You can also solve these problems utilizing Microsoft Excel, but for the purposes of this video and for this course, I do my calculations utilizing this financial calculator. So the first method that we're going to discuss is the payback period. So the payback period is essentially how long does it take before a company will recoup the investment that they have made within a particular project. So for this problem here, it says a project has cash flows of $124,000. That's the initial cash outflow in year 0 to get the project started. And then we have cash flows of $56,600 coming into or being generated by the project in year 1. $51,400 in year 2, and then $86,300 in year 3. The required payback period is 2 years. So for this problem, the company wants to recoup their investment within 2 years. We need to calculate the payback period and compare it to this 2-year threshold. With many of these problems, I do recommend drawing a timeline so that you can visually see the amount of the cash flows and when the cash flows are actually occurring. So in this scenario, we have a 3-year project. So my timeline will have 3 periods. In year 0, there is a $124,000 cash outflow, which I'll represent with a negative value to showcase that that is what the project is costing. And then it is generating a cash inflow of $56,600 in year 1, $51,400 in year 2, and then $86,300 in year 3. Notice here with this problem, when we're calculating payback period, we do not utilize a discount rate. This is really a method that kind of ignores the time value of money. In your textbook, you can see that there's also a discounted payback period, which does introduce time value of money. But in this case, we're really just trying to identify how long will it take me before I recoup that $124,000 initial investment. So when calculating the payback period and drawing a timeline, I recommend creating a cumulative line, which will showcase how much we still need to recoup after each period. So in year 0, we still have our initial $124,000 cash outflow to get the project started. We then generate a cash inflow of $56,600. So at the end of that first year, if we took a negative $124,000 and added $56,600 to it, you would realize that we are still in the hole $67,400 at the end of this first year. We then add to it that $51,400 value that we would receive in year 2. And if we did add that $51,400 to the negative $67,400, you would see that we are still in the hole $16,000 at the end of this second year. Now, by evaluating these two cash flows of being still in the hole $16,000 but generating $86,300 within that third year, you should see that we would recoup our investment sometime between the second and third years of this project. So if we have a partial year, to calculate the fraction of a year when we're utilizing the payback period method, it's going to be 2 full years before we recoup our investment. And then to calculate the partial year, we take the amount that we still need to recoup, which is $16,000, and divide it by that next year's cash flow, which in this case is $86,300. So when I do that calculation, it would be 2 full years plus a fractional year of 0.1854 for a total of 2.1854 years before we recoup our investment. Based on the required payback of 2 years, we would actually reject this project because it does not meet our 2-year threshold for recouping our investment. So we do assume that last year's cash flow is received equally throughout that year when we're calculating our partial year here in this scenario. But this is how you would calculate the payback period. It's really just thought of how long does it take to recoup your investment, and then you compare how long it takes to recoup that initial investment amount to whatever your threshold is to decide whether or not you would accept or reject the project. The second method that we're going to discuss is net present value. This is the method that is used most frequently by companies, and it is the method that is most consistent with our goal of maximizing shareholder wealth, which was discussed in an earlier chapter. So when we are calculating net present value, all we're doing is calculating the total present value of all of the cash flows. So in this case, we have an initial cash outflow of $46,100 in year 0 to get the project started, and then you can see what the 3 years of cash flows are that will be generated in years 1, 2, and 3 over the lifespan of this project. What is the net present value if our required rate of return is 11.9%? So should we accept it or reject it? When you are utilizing net present value, your threshold is 0. If your net present value is less than 0, that means that the project costs more than what it's actually generating in cash inflow, so it actually decreased the value of the company, so you would reject it. If it's greater than 0, it would add value to the company, so we would say that we would accept that project. If it's equal to 0, we say that we are indifferent on that acceptance or rejectance. It doesn't increase the value of the company, but it doesn't decrease the value of the company either. And this is further discussed in the textbook as to what happens if you have a 0 net present value project. So in this case, again, I do recommend drawing a timeline to visually see the cash flows associated with the project. And once again, we have a 3-year project with an initial cash outflow of $46,100 in year 0, $21,250 in year 1, $14,950 in year 2, and $14,100 in year 3, and our discount rate is 11.9%. So when you are calculating net present value, essentially what you're doing is you're taking all of these cash flows and you're discounting them back to a present value, and you want to know what is the present value of all of these cash flows, and then we compare it to a value of 0. If it's greater than 0, like I said, it would add value. Less than 0, it would reduce the value of the company. So you could do each one of these cash flows separately, utilizing the time value of money tools that we covered in Chapter 5, or you can utilize the net present value function on your financial calculators. So the first thing that you're going to do when calculating the net present value on your financial calculators is go to your cash flow function, your cash flow register on your calculator, and make sure that you clear all the cash flows that are included in that register from any previous problems that were solved. CF0 represents the cash flow that is already in present value terms that would not need to be discounted. In our case, it is the initial cost of this project, so we are going to input negative $46,100. It's important to realize that when you need to store the values in your calculator that you do hit the enter button. Do not hit equals, it won't store the value. You need to hit enter in order for it to store the value. The enter button is on the top row on your financial calculators. Once I hit enter, I'm going to push the down arrow. When I push the down arrow, I should see CO1. CO1 represents the cash flow that is in time period 1 and would need to be discounted back 1 period. In our case, is $21,250. Once again, you have to hit enter in order to store your value. When I push down, you see F01. The F stands for the frequency of that cash flow. So how many times does that cash flow occur consecutively? So in consecutive periods. In this case, it's already preset at 1 because the cash flow needs to occur at least once. In this case, it's only occurring that one time, so we leave it at 1. We push the down arrow, and you should see CO2. CO2 represents the cash flow that needs to be discounted back 2 periods. In our case, it's $14,950. I hit enter, and then I push the down arrow, and I see F02. Once again, what is the frequency of that cash flow? It only occurs once, so I keep it at 1. I hit enter, I push down, I should see CO3. CO3 is the cash flow. It needs to be discounted back 3 periods in this case, or the third cash flow for our purposes. 14,100 is that value. Push enter, and then I push down. I see F03. F03 is the frequency of that cash flow. It occurs once. Now what I need to do is I need to tell my calculator what the discount rate is. So I hit the NPV button. When I hit the NPV button, I should see an I. That I represents your discount rate. So for our purposes, our required rate of return is 11.9%. So that is our discount rate. Once again, I have to hit enter to store this value. And then when I push down, you should see NPV, and it should be a blank value. So I hit NPV, and then I hit the CPT button, compute, and it computes the net present value of all of these cash flows. And for this particular scenario, I get a net present value of negative $5,100 $107.44. Since this is a negative value, the cash outflows exceed the cash inflows in present value terms by over $5,000. We would reject this project because it would actually decrease the value of the company. There are many videos online on how to calculate net present value using a financial calculator if you're still confused. The chapter PowerPoint also kind of discusses this a little bit, but this is our calculation of net present value utilizing the net present value function on the financial calculator. In our next problem, this one's a little bit different just because we have cash flows occurring of the exact same amount for multiple years. So once again, I'm going to draw a timeline. In this case, I have a 13-year project. So my timeline technically should have 13 years. You can see that I'm going to condense it slightly because we have the same cash flow occurring for the first 12 years of this project. In year 0, we have a cash outflow of $394,500. That is our initial cost of this project. Then in years 1 through 12, we are generating cash inflows of $51,200 each of these first 12 years. Then in year 13, we have a cash inflow of $72,900, and we want to know what is the net or the total present value of all of these cash flows for each of these time periods, each of these 13 years, if we discount these cash flows back at a 9.1% discount rate. Once again, I'm going to utilize the cash flow function so I don't have to do each one of these separately using time value money. I can use the net present value function and just input all of the cash flows into my calculator and discount them back at 9.1% to calculate what the total or the net present value is of these cash flows. So once again, when I hit the CF function, I need to clear everything by hitting second and then clear work, which is the bottom left-hand corner button on your calculator. So then my cash flow function or my cash flow registry is cleared. CF0 represents the cash flow in time period 0. In this case, it is $394,500. Once again, I need to hit enter to store this, and then I push the down arrow, and I should see CO1. CO1 is that first group of cash flows. In this case, it is $51,200. When I hit enter and push the down arrow, then I see F01. F01 again represents the frequency that cash flow occurs consecutively. In the previous problem, all of our cash flows occurred once. In this case, I have the same cash flow occurring 12 years in a row, so I can actually change this to a 12 and then hit enter to store and tell my calculator that cash flow occurs 12 consecutive years. When I push down and I get to CO2, my calculator now knows that this is actually the cash flow in year 13 that would need to be discounted back 13 periods since I changed the frequency of that first cash flow. So CO2 would be the next year's cash flow, in this case, year 13, $72,900. Once again, I have to hit enter, and then I push the down arrow, and I see F02, and this tells me how many times does that cash flow occur consecutively, and it only occurs once, so I leave it at 1. Now that all of my cash flows are input into my cash flow register, I hit the NPV button where I see an I. The I represents my discount rate, so I would be, in this case, 9.1%. And then when I hit CP, or I have to hit enter, and then the down arrow, and then I hit CPT for computing the NPV, and I get NPV equal to negative $6,213.95. Hopefully by this point you realize that if I have a negative net present value, this would actually decrease the value of the company. So the cash outflows actually exceed the cash inflows by over $6,000 when they're all listed in present value terms. So since I have a negative net present value, we would reject this project. So that is your net present value calculations. That is our second method that is discussed in this chapter. The third method is the internal rate of return. So the internal rate of return and net present value are similarly related, except for the internal rate of return, we are solving for the discount rate that sets the net present value equal to 0. We then compare that discount rate to our required rate of return. So again, here we have a project. This is a 3-year project. Our required rate of return is 12%. What is the internal rate of return on this project? Once again, a timeline could prove to be very beneficial. So in year 0, I have a cash outflow of $29,200. In year 1, a cash inflow of $14,600. Year 2, $18,300. And in year 3, $9,800. What we are now solving for is what is the discount rate that would force the net present value equal to 0 on these or on this project's cash flows. They're solved very similarly to net present value, where we need to input our cash flows into our cash flow register. So since I've already kind of explained how to input the cash flows into the cash flow register, I'll just show you what our inputs are for this problem. If you're still struggling, or if you just fast forward the video to this problem, you may want to go back and look at our net present value problems on how you input the cash flows. So our CF0 here would be a negative 29,200. CO1 is equal to 14,600. And since these cash flows only occur 1 year consecutively, we just keep our frequencies as 1. CO2 would be 18,300. FO2 is equal to 1. CO3 is our 3rd year's cash flow, 9,800. F03 is equal to 1. So we want to know, and you can only do this using a financial calculator or using a program like Excel, otherwise you'd have to guess and check on this, is what is the discount rate here that would force the present value of those future cash flows equal to the present value of the cost. So in these purposes here, it's a little bit more straightforward than calculating IRR. All you do is hit the IRR button on your calculator and then compute, and you would realize that we get an internal rate of return of 23.08%. Our rationale behind whether or not to accept a project or reject a project based on the internal rate of return is, does the internal rate of return exceed the required rate of return? In our case, we have an internal rate of return of 23%. The required rate of return is 12%. So we would accept this project as the present value of the cash inflows exceed the present value of the cost. And then the last method that is discussed in this chapter is the profitability index. The profitability index is also known as the benefit cost ratio. It is very similar to net present value, except instead of doing the net present value of, or the present value of the cash inflows minus the present value of the costs, it now divides them. So what we end up having is the present value of the future cash flows divided by the initial cost. So it's called the benefit cost ratio because for every dollar that I'm spending, what type of present value of cash inflows does this project generate? So in this case, once again, I have a 3-year project where year 0 has a cash outflow of $17,500. Year 1, $10,500 cash inflow, $9,400 in year 2, $7,100 in year 3. Our discount rate in this problem is 15%. We want to know the present value of these cash inflows, which we will then divide by the present value, which it's already in present value terms, so dividing by the initial cost. So once again here, we are solving for the profitability index, where our initial cost is $17,500. We do use a positive value here in our calculations. The negative in our timeline just showcases a cash outflow as opposed to a cash inflow. And we need to know what is the present value of the future cash flows. Hopefully you realize that when you're trying to solve for the present value of multiple cash flows, you can just utilize the NPV function on your calculator. The difference here from our net present value calculations in our previous examples is that we do not include the initial costs in our net present value. We only want to know what is the net present value of the future cash flows. So the cash flows, I'm putting a rectangle around here. So CF0 is 0, CO1 is 10,500, F01 is 1, CO2 is 9,400, F02 is 1 since it only occurs once, CO3 is 7,100, F03 is 1. So when I hit the NPV button to input my I would input in that 15% discount rate. When I solve for the net present value, I get a net present value of $20,906.55. So this is the present value of the cash flows after time period 0. This is our numerator in our profitability index equation. So I get 20,000 906.55, and I divide it by the initial cost of 17,500, and I get a profitability index of 1.19. So in this case, for every dollar that I'm spending, I'm generating $1.19 in present value cash inflows. This value is basically compared to a value of 1. If it's equal to 1, then the present value of the cash inflows equals the present value of the cost. If it's less than 1, your costs exceed your cash inflows. If it's greater than 1, which it is in this case, the cash inflows exceed the cost, so you would accept this project if using the profitability index as your rationale or as your method. So those are the different methods that are utilized in this chapter. Again, when you're evaluating these projects in the corporate environment, many times you'll utilize more than one method to ensure the correctness of your project or of your analysis. The most commonly used methods in practice would be the net present value method and also the internal rate of return, but they all have their benefits and their ability to help companies choose which projects they should move forward with. So good luck with your homework for this particular chapter. If you have any questions with anything, don't hesitate to contact me, and I will speak to you all soon.